Good afternoon. This is Sunanda from Lavan Investing. And for our weekly webinar, we have the topic of importance of portfolio positioning. So to understand more around the current market scenario, we are back with our panel of Vijay Raj, the portfolio manager of Lavan Investing, along with different investment manager who would share their insights on the topic. So let's get started. Over to you, Vijay.
Okay. Hi, good afternoon. This is Vijay Raj again. Lovely Wednesday and a very beautiful afternoon in Sydney. And after a while, I've been to all the shoppings with my wife and kids and having some coffees outside. So that is a good and lucky thing in life. Going forward, like we had a discussion with Banyan Tree people and Zach and Max and those people, and we just discussing where last 3-4 weeks we were talking about lot of changes happening into the economy and those things. And then again, as a portfolio specialist and portfolio construction man, we had discussed where should we go? Asset allocation. Now, asset allocation is the key for all the things like dynamic asset allocation or strategic asset allocation, or how with the changing of the scenarios, how the portfolio should be positioned. So let's talk into a little bit more detail. Let's talk about some global economic thing. What are the different asset classes that have performed? And then I'll give to my colleague, I think Pooja, let's talk what is our global assets happening and where is the whole dynamicity of the things, which areas are moving and which is not moving.
Interesting topic, how global asset classes are performing. So this chart shows the investment returns for all major classes this calendar year so far and the last year 2020 during pandemic. So stocks in Australia like Afterpay, PointsBet, Telstra, and globally like Amazon, Google have delivered a solid double-digit returns in 2020 and to date 2021 up till now. So interest rates obviously remain low around the developed world, and that continues to drive investors into equity market for returns. Returns are low in credit and bond markets, but equities are definitely doing well. And if we see the Australian listed property trusts have had a good year so far, being around up by 18%, as they have now fully won back the share price falls across the sector in 2020. So markets is betting rental income that these property owners earn is now much safer as we come out of lockdowns, with economic growth is looking better. So moving to the next slide, the global equity markets are roaring. So on this chart,
as you talked about, let's go back onto that asset. So asset classes now, I think in that asset classes, the Australian stock is around 20.5% returns, almost unbelievable. And then you have, when we talk about the global stock, global markets or mainstreams, more Eurozone and the US dominated thing. So that is also 17.6. And then again, Australian property is coming and global property is almost 28%. So I think properties and stock has come across in a big way.
That's very true.
Why is that? What do you suggest? Why is that?
So as we have seen since last year, Australian shares, which so far this year have delivered 17.4% after delivering only a minor positive return in 2020. So we specifically see the focus on equity asset class and look at the investment returns in various stocks. So ideally, low interest environment has created a property bubble.
Yep. So yeah, I think it's a lot of liquidity, and I think the consumer sentiments coming back on the track, and people are getting more confidence, and the companies performing well, and more returns and economy GDP growth rates coming across. So that has flowed into the whole liquidity flowed into the asset classes into those two area. How about the gold coming up? Gold is the safe haven. So I think it was doing good last 6 months back, I think, and now again, gold is like 1 year is -10. So I think that is also the signal coming across, like basically on both the sides. From the safe haven, people are getting confidence into the market. So I think that is a trend coming up. No, I agree. No, brilliant. Thank you, Pooja. Brilliant.
Okay, so yeah, moving to the next slide, global equity markets are roaring. So we can see there are lots of green on this chart, which are, we can see the returns are double digit every year. We can see at the top, which are Australian shares, which so far we discussed that they have delivered 17.4% return, which is a very good return. Coming to the US equity market, S&P 500 has also been red hot strong this year with a return of 22.4% so far this year. And last year it was also strong, around 18%. So it doesn't feel like these markets are reflecting any economic disruptions caused by COVID-19. If we see, there has been a good returns in equity sector during this pandemic. On emerging market side, if we see Indian market has had a solid year so far with a total return of 31.3%, which is tremendous. As investors, they saw India recover as well through this COVID breakout earlier this year. So yeah, this is how the equity markets have been roaring. If we see the Asian market, that has also delivered solid returns.
Just give me 1 second. I think we'll talk in more detail. Can you go on to the last one slide, please? With regards to that particular overall returns, then I think the Indian market has come across it to, and overall that has in the 1 year that is almost 49%, staggering. Why is that?
Yes. India has done tremendously well during this pandemic. As of now, we have discussed the return has been 31.3%, which is seen that investors are highly recommending to invest in India market.
Yeah, no, 31% you're talking about the US one, that's absolutely right. And the Indian one is 49%. Yes, that's all, because that's the highest 1 year. Anyway, yeah, yes. So, and we talk about the second one, the Chinese Composite Index, because that is also a major market. That is the 9.3, the lowest. Max, would you be answering a little bit, just 1 or 2 liner, very small? Why the Shanghai is the, I mean, in all the double-digit figure, we got only Chinese market Shanghai Composite Index shares. I think that is 9.3. That's a single digit. Why is that?
Yeah, China's traditionally struggled as a mark. I mean, look, I mean, while I say struggle, they've still delivered pretty good return overall. But their economy sort of does one thing and the market does another. There's a lot of retail investors in the Chinese market. There's not, because it's a closed market, there's less participation from institutions. And another thing of late that's happened in the Chinese market that's detracted returns is obviously the Chinese regulatory clampdowns on the likes of Alibaba and the technology companies on more regulation that's coming in. And then obviously there's property sector, bits of property sector in the market that's had disruption through Evergrande and various other companies. So there's pockets of issues that the Chinese market had to deal with. From regulation and other bits and pieces that has detracted from the returns there.
Fantastic, Max. Thank you for that. Yeah, back to Pooja. Thank you.
Yep. So moving on to the next slide, the rising risk. So having reviewed the great performance of the equity market so far globally, it's a natural question to ask, are these returns sustainable over the next 12 months? So can the share market deliver another strong a year of double-digit return? Every investor would have this question. So we think the risk is rising for the share market in the coming few months. Yes, of course. But broadly speaking, there is currently an issue of transitory inflation in rises or in prices of every goods and services right through the economy. So if you look at the chart on the left, it shows inflation of prices in the US ranging from food, furniture, and used cars. So there has been a considerable spike in the inflation. So, yep, moving to the next slide.
Yep, I agree with that, because when I go to the service station to put the gas in, I got that a little bit pale car, plug-in hybrid a little bit, but still I had to put it a little bit, and that $1.80 price of the gas is even too expensive, you feel it. So I think you are absolutely right that one of the transitory inflation, and actually the price goes on increasing. Technically, the consumer confidence decreases. So that is one of the things to be coming and observing. And I agree with you onto that. And that will drive, because consumer spending drives the markets. And then again, the good companies and the profitable companies grows on. and that drives the price and sentiments across the board. So that is the little bit risk as you put on the slide. So we're fantastic. Well, thank you.
Absolutely, Vijay. So yeah, economic activity which is measured in real time. From this chart, that quarterly real GDP growth rate as almost falling off a cliff over September and October to around 0.5%. And it's due to personal expenditure indicators becoming weaker, like the one on consumer sentiments I showed on the previous page. So yeah, consumer sentiments, inflation rates have been increased. So that's how the GDP has been, the growth rate is decreased. Yep, moving to the next slide. So here we see that why the bonds have been unattractive, because the equity has been giving the solid double-digit return. According to the fund manager survey, bond rates are decreasing. So no one wants to take a long-term bet on bonds as an investment right now, given how low the interest is. The rates right now, with risk of inflation dragging up bond rates, looking real. Even on a short-term basis, it is causing investors to reduce their exposure to bonds, and they are attracted to equities. So moving to the next slide, where we discuss like why equities look attractive to the bonds in the previous slide. So equities have definitely, given a good return. They are attractive compared to the overpriced bond market. So this is a chart of equity risk premium, which tells if the returns from taking extra risk is attractive compared to investing in risk-free government bonds. So which definitely makes investing in equities still a reasonable proposition compared to bonds.
Pooja, when it is, I think, just give me 1 second onto that. Now, Zach, look, I think last the whole 10 years of this whole history, the interest rate across the globe is coming down like from 7.68% and then now coming to 0.2, 0.3. And then what's your opinion onto the bond market over here?
Yeah, look, obviously the bond market has been in it's in a massive rally. Obviously, bond yields have gone from 8% to where they are today, 1.7, 1.6. That's a significant growth in capital for bondholders. It's a matter of a couple of things. Firstly, it's the ability for the market to take higher, and I'm talking about consumer, government, and also corporates, because of the debt buildup. The ability to take on additional, 100 basis points increase in yields, which obviously gets reflected in borrowing costs. That's a lot of money. Then that has to be put away to interest repayments to service debt. That takes a lot out of people's budgets, corporates, P&Ls. So it has a dampening effect. So look, our belief is, or certainly my belief is that bond yields getting up to 3.5%, 4% is just going to be tough in an environment where structural changes in certain industries are dampening prices, and corporate costs are just something that, given where the debt levels are just very hard to absorb in the current environment. So yeah, long term we believe yields are going to probably be lower to where they are, and I'm talking about 5 to 10 year view.
Yep, so fantastic. Look, thank you, Zach. I think you're an expert and I appreciate. Thank you. So going forward, Pooja, back to you. Yep.
Yeah, moving further, if you see, this chart shows US manufacturing PMI. So PMI is basically a monthly indicator of US economic activity, which is based on a survey of purchasing managers at more than 300 manufacturing firms. So it is considered to be a key indicator of the state of the US economy. The indicator has come under pressure since April 2021. And typically when this PMI falls, it caused a fall in the equity market with some delay, of course. So far, the equity market hasn't followed the falls of this PMI. But yes, combined with persistent inflation and weakening consumer sentiment, we think this is adding to the pressure on equity market in the near term. So that's where the question is, that how the equities will be performing.
Yep, no, I think you are absolutely right, because the purchasing manager of the company, they buy considering the scenario that future they need to produce these things. So there is a demand. So purchase manager index PMI is one of the major things, like what the managers are buying to produce for considering the future demand and forecasting. But so very important indicator, and the little bit coming down is going the sentiments that okay, there will be a little bit slowdown into this quarter or next quarter of the GDP or across the board. That's what's happening. Yes, no, I agree with you, Pooja and Zach. Yep. Now I think, Pooja, we were talking about a couple of stocks with Zach and Max as well, and then they come across which stock we should be talking, and I think Thai has said something as well. So now let's talk about, I think, I don't know which stock to go at the highest market. I think we should be going for the growth stocks, or we should be betting. It's a very asking question at this typical juncture of market is a risky question, but still, as I